good morning, and welcome to the Financial Pillars All About the Money podcast, presented by Our Neutral Voices Media. Our show is all about helping our audience understand money, mindsets, and tap into the economic knowledge that builds financially secure individuals, families, and communities. So whether you're tuning into our show to learn about budgeting, building credit, investing, or starting your own business, we're here to break down the knowledge in a real and relatable way. Before we get started today, gentlemen, Pastor T, you want to take us in with a little prayer?
Sure, why not? All right. Dear Father, thank you so much for waking us up this morning and starting us along our way. Thank you so much for allowing us to come together again and share our knowledge with our communities and our families and friends. And I pray that they're able to take this knowledge and apply it to their lives in a way that they see fit as we all grow closer to you. In your name I pray. In Jesus' name, amen.
Amen.
Thank you. So, I'm Ryan Leopard, private banker with Star Financial Bank.
JJ Foster, loan mortgage originator, Lake City Bank.
Terrence, I am a personal banker, Star Financial Bank.
And Ben, branch manager, Flagstone Bank.
Been a couple weeks, gentlemen. It's good to be back on set with you today. Let's talk about building credit, kind of to understand the importance of it and why maintaining a strong credit history or profile is important. So starting off, what is credit? Like, what does that mean?
I would say credit is your electronic, I would say, I don't want to say accountability, but it's like your online worth. I would say in a financial network, of course, it pretty much tells people how likely you are to pay your bills back on time. It tells you how responsible you are in terms of repaying your debts, of course, making sure things are paid on time, making sure that you're not late with your payments. Of course, it pretty much tells creditors and lenders how much of a risk profile that you're going to be for them, essentially. For example, when you need to go buy a car or you need to finance a loan, they're going to take a look at your credit profile, of course, and that pretty much goes through your history of how long you've had credit established, how good your credit score is, other factors that play into that, like how many credit accounts you have open. Of course, all that goes into that profile to pretty much show them how worthy you are as a person to want to lend to, and pretty much tells them how much of a risk that it's going to be for them, essentially, when they loan that money back to potentially recoup those funds plus gain profit from that as well.
Yeah, kind of like your credit risk profile.
I love his explanation, and I'm with him now. But when he started out electronic and all that, I'm like,
I would,
this young man going.
I would say electronic because we do have the generation of people.
Right, yeah. But if I have their electronic, everything that you said is in play. You're exactly right. And I simply always tell people, we all know what a job resume is. Credit is just your financial resume, because everything, like Terrence said, is going to tell people, can I lend you money? Are you responsible for paying me back? And it's your resume.
Mm-hmm. So that resume there, where does this information come from? There's three major credit bureaus. Ben, you want to kind of touch on that?
Yes, so TransUnion, Experian, and Equifax. Mm-hmm. And I wanted to touch on the FICO ranges a little bit just to create more of what that looks like. So a FICO range of 300 to 579, that ranges into poor. And I was looking at the statistics. It looks like 15 to 17% of consumers are within that range. A FICO range of 580 to 669 is considered fair by banks, and 17 to 20% of consumers are within that range. 670 credit score to 739, that's a range of good, and it looks like statistically 20 to 25% of consumers are within that range. 740 to 799 is considered very good, and 25% of consumers are within that range. And 800 to 850, that's considered excellent credit score, and 20% of U.S. consumers are within that range. Overall, nationwide, an average credit score came out to 715 to 720, but I know that can be significantly lower average-wise when it comes to marginalized group or minority groups.
Gotcha. Yeah. So when you have the three different credit bureaus, you're talking about those credit scores, are each credit bureau the same credit score, or how does that work?
It all really depends because each is reported different. It also depends with which credit consumer merchant reports to which, but majorly all lenders should report to three of them. But also, it also depends with when we're borrowing, which one is pulled more. So you may find like certain lenders may rely more on Equifax when it comes to lending. Then more of them may rely on TransUnion. I would consider a good average being all reported on all the three credit bureaus, but it all can differ significantly based on how often that credit is billed and how often it's reported on that.
And I was going to say, tying it back into my young fella too, you heard what Ben talked about. Most lenders, you do the tri-merge. Like he broke down all three. Most do a tri-merge, and then you take the middle score. But, to Terrence's point, I get it with the electronics. Everybody knows their score. They're going to tell you, they're going to get the FICO score, and they're going to tell you what it is. So then when it comes back different, it's wonder, well, hey, my FICO said it's this because it's at everybody's fingertips. And like I tell them, it's going to give you a general idea. And I appreciated it, when people, they give that number. But at the end of the day, we're pulling, all three. So
yeah, so those numbers are coming typically from like a third-party company, not one of the three credit bureaus for it. So it's going to be similar, and to JJ's point, give you a idea of where your credit score is, but it's not going to always identically match to what your actual credit score is when somebody like JJ goes to pull your credit for an application, and now it comes back with the actual score from TransUnion, Equifax, and Experian. So been some time since I've kind of dealt in depth with that, but to my knowledge, it was Experian, TransUnion, and Equifax are on different sides of the country. One's in the East, one's in the Midwest, and one's in the West Coast. So the reason why it differs sometimes, usually nationwide companies like a Chase Bank or those, I think they're going to report to all three. But you have a little local like Three Rivers Credit Union, they're probably not reporting to all three. They're going to report to the more local one. And that's kind of why those credit scores differ a little bit, is because some smaller lenders that may be more regional based or local based may not be reporting to all three.
Yeah.
Do you have any insight on that? It's kind of your experience.
No, yeah. I mean, I think you explained it well, but then the other part, I thought you was going to break down the formula, which,
I'm not going into the formula. There's too much into that.
I was going to say it hasn't been explained, and few people really actually know, what all goes into that. So
yeah, I mean, I got some general ideas of that. I mean, as far as like your credit history, obviously, if you got delinquencies, and when we're talking about delinquencies, if you got a bill that's due and you're 15 days late, that's not reporting to the credit bureau, right? They're reporting in increments of 30 days. So 30, 60, 90, 120. So if your bill's due on the 1st, and now we're on the 2nd of the next month, you're over 30 days delinquent. Now that's reporting to your credit bureau. That's when it starts affecting you.
Yeah.
But if your bill is due on the 1st, you pay it on the 15th, well, you might have a late fee with your lender, but that's not negatively impacting your actual credit score. But then there's, drawing a blank on the exact terminology for it, but how much you owe in comparison to your
utilization.
Limits, right? Utilization.
Yeah. Okay. You got the utilization, and it's funny when you talked about when it's reported when you pay. One thing that I always, want to remind people, it's like, hey, I'm paying my bill, but I'm consistently paying it late. Mm-hmm. So the fact that you say that you're paying your bill, but like you're paying it late, is showing up on that's affecting your credit bureau. Mm-hmm. So
are you talking less than 30 days delinquency, or are you talking about?
I'm talking about, let's say, whatever your due date is the 16th, you paying after the 16th. If it's showing up as hitting as delinquent on your bureau, that is affecting your score. Even though you're paying it consistently, the fact that you're paying it late is having an adverse effect.
Don't they only report in 30-day increments? So, for example, like you're only going to, because they only have 30, 60, 90-day delinquencies that show up on there. So you might be delinquent with your lender, but the lender's not reporting that for another 15 days because they only report to the credit bureau once a month.
Okay. 30 days, you pay 31 days.
31
Whichever
days
the case it is.
Yeah.
If you pay it consistently, it is late. It's affecting.
Say, trust me, I've never had a credit bureau delinquency, but I paid 10, 15 days late a bunch of times. It cost myself some money for doing it, but never had an actual delinquency on the credit bureau for that. But utilization. So, for example, like if I got a credit card and I have a $5,000 limit on there, typically is it 30%? They want to see that you're like 30% or less on that. When you start to get above 30%, then it can start to bring your credit score down a little bit. So let's use round numbers because I'm not a math genius here, but you got $1,000 limit, right? You got $300 on it. If you're rolling that over from month to month, then it could negatively impact your credit the higher you are. So $700, you're at 70%. If you're below 300 or less, then it may not have a negative impact on there, right? Same thing. I know there's, and JJ, maybe you can speak to this as well. There's a lot of theories out there that like, hey, if I have a credit card, I can either choose to pay that minimum payment, right? And in which case the balance rolled over and I pay interest, or I could pay the credit card off in full and I don't pay interest on it. Well, I have to pay interest on my credit card in order for that to help my credit. If I pay my balance off in full each month, that doesn't benefit my credit.
No, the fact if you're using your credit card and you're paying it off, that's building credit.
Yeah.
That's building credit. Yeah, not keeping that interest costed you. The other thing is funny. You were talking about balances. Yeah, high balances hurt you. And if you got multiple, if you got 10 different credit cards and all of them got a $10,000 balance, that's not boding well for you, either.
You're
But
overextended with those,
there-
right?
there-
Your credit limit's
there you
10,000,
go.
you owe 10,000, and you're maxed out on that. That's not a good thing for it. So we got that. We also, with credit, number of trade lines, right? Can you kind of speak to the number of trade lines and kind of how that helps and
Yeah,
hurts?
I'm like we having a one-way conversation. I love it, man.
Yeah, of course. Yeah, absolutely. Especially on the retail side of things,
Yes.
you see several different types of, I call them credit accounts, of course. As we know, in terms of building credit, I always recommend getting an open line of credit, of course. Having an open line of credit means that it is revolving. It will stay open as long as you keep it open, or as long as you take care of it, or as long as you don't have any major financial crisis take place where your creditor would close the card for their own benefit, of course. With that being said, of course, keeping lines open is going to help you build an extensive credit history, of course. And then you have your closed lines of credit would be your like auto loans, short-term, personal loans, mortgages included as well. Pretty much once you open that line, once you make that final payment, it is going to close. It will impact your credit history, of course, but in a sense, it will also gain you credit over the long term and show creditors that you do have a history of making continuous payments over a longer period of time. Typically, the main two that you will see is the revolving open lines of credit and the closed lines of credit, of course. There's typically not a limit of how many credit accounts you can have open at once. Of course, it is dependent on your credit score and your debt to income ratio and how much you're able to finance, of course. You can have several credit cards. You can have an auto loan out there, several auto loans and a mortgage as well at the same time. I will say creditors typically do like to see that you have more than one credit account open at once. I will say that. I will say, and from what I've seen as well too, it's typically boded well for more of my clients if they've already had a mortgage showing on their credit history as well too.
Yeah, and I was gonna say you talked about the trade lines. You had 3 to 5 to establish that history, because to Terrence's point, if you don't have any revolving credit or there's nothing open, you won't have a credit history, and that's something that we haven't talked on. There's no your tri-bird is gonna say there's gonna be no scores because there's not enough credit there to report on.
Mm-hmm. So we said 3 to 5 trade lines. I'm 18 years old. I can start getting credit. How do I even go about starting to build credit, right? Like, how do I get to 3 trade lines?
We talked about it. They're gonna send you them flyers. You can open up that credit card. And I just talked to a group of high school students. I mean, it's not necessarily a bad thing. It's only a bad thing if you're not responsible and paying it off and doing the things that you're supposed to do with that credit card. But if you get one of those, if they send it to you, you're responsible. It's like what we're talking about. You're not spending any more than you can pay off at the end of that month. Mm-hmm. It's a beautiful thing. You're building your credit. And we actually touched on the rewards programs that some of these credit cards have. So you could be getting, some little perks on the side. But in order to establish positive credit, it's going to take you to having that credit card could help.
Credit card's a good way to start. So I get a credit card. Now how to get this second trade line? Like if I go and apply for, let's say, another credit card, a better credit card, and I get that card, should I close the other one? What should I do, Ben?
So at least a consumer wants to keep the longest credit cards they've had. So that looks more like the first credit card that they applied for. But also it draws down now back again to the strategy that one person has. So for instance, when I meet with someone who's looking to build credit, I always ask them paint me a picture on your credit card story, on your credit building story. What does that look like? What is the strategy that you have in place? What are the strong pillars that we can put around your credit building plan so that we can make sure at least we're sticking to it, but we're helping you build credit along the way responsibly? So one of the things we would potentially look at would be for someone who has no credit history, may have a difficult time getting their first credit card. And you'll find a lot of people will get stuck on that phase because one, they try to apply for a credit card, they get denied because one, they don't have a relevant credit history. So it may draw down to one, either being added as an authorized user by someone you trust, or applying for a secured credit card, or even researching to see which credit card company can provide your first credit card without you putting money down as a security. Now, with the first credit card, you'll find a lot because there's a very short payment history. Let's say, for instance, if it's a secured credit card, you put 300 down, that is your 300 credit limit, or you qualify for your first 500, and then your utilization now start getting high because you have that low credit limit. So utilization really come into play. And I always say your first credit card can set tone on how you build credit. That is your first credit card. You want to understand the utilization that is staying with below the 30%, but also now figuring out a way where you come again and say which other credit card or other trade line that I can add to make sure that I'm building relevant credit. And so the first credit card, the limit is typically low, stick within below the 30 limit. Research again after a relevant, maybe like a 6-month payment history, and seeing another credit card that you could potentially qualify for and apply for that. I normally recommend at least 4 trade lines. But again, as you're borrowing money within those trade lines, you want to make sure, one, we're borrowing it responsibly. And I would say credit card offers us an opportunity where you can just keep it open and you're not paying interest. Or at least use it very seldomly, like for gas or groceries, and pay it off.
So we take 3 to 4 trade lines. Obviously, it takes time to build up that way. Like I wouldn't probably suggest you credit card.
Yeah.
Right. Just having 4 credit cards just to get that trade line. But
Yes.
usually a good route is, I'll ask the question. So I got a credit card, right? And I need to get a car. I got 10 grand in the bank here. Can I go buy that car in cash, or should I get a loan for that? T, what do you think?
Well, that is going to be depending on your current financial situation, of course. Using cash, of course, if the car is within the means to purchase outright, no financing is needed. If you're willing to pour that cash out of your pocket, of course, go get the car. You're going to escape those finance fees. You're going to escape paperwork. You're going to escape the credit pool. You're going to escape all of that. You mentioned having a credit card. I would never recommend buying a car on a credit card. Lastly, I guess it depends on what your interest rate is going to be. Of course, if we're saying you found a great deal and your interest rate is going to be like 2%, if that's something that you're willing to pay for at the time, of course, I would recommend going financing. But if you just want to get it done and over with, I'd say just drop the 10K cash.
Mm-hmm. Can I? Please. No. He was talking about building credit. So to his point, you get that credit card. Let's say the interest rate isn't the best, but it's all right. Yeah, right. I'm gonna buy that. I'm gonna get a loan out for that car to establish that trade line that we're talking about.
Yeah. Maybe I put $5,000 down on the car, but I'm gonna take a small loan for $5,000.
So where you're paying, just building. So we're talking about building.
So are we saying in a sense where you've already had credit established?
No, we're saying starting out.
We got one credit card. I'm trying to build up to that 3 trade lines so I can go get that mortgage. Right?
Yeah, I understand that.
Credit cards. I want to have some different lines of credit. So
okay, so basically we're gonna take half of our cash essentially to lower how much we need to get financed, of course, because our credit history probably hasn't been established that long.
Yeah.
Okay. Or not even gonna take half your cash. You may do the whole 10. Like you said,
exactly my point. But if we're, of course, but to speak to your point, of course, if we're going to build credit, of course, financing it, of course, would be the best way to go about that. And I did want to speak to the word of Janae. Good morning to you as well, and to Jonathan. Of course, starting with helping people establish credit, of course. The secured personal loan and typically the secured credit card are typically the best ways, especially for young people starting off, especially to answer your question, being like an 18-year-old looking to build credit, of course. I typically would always recommend the secured card. It is a safe and effective way to build credit that also gives you collateral as well if you're unable to make the payments.
Now, to clarify that, though, would you do a secured credit card before you do a normal set of credit card?
I would, especially if that's your first credit card, because one, you have better chances of approval. Lenders don't have a payment history, so they have no way of trusting you to give you credit card. And that's where you find a lot of people get stuck because they have the desire to build credit. They're applying for credit cards, they're not getting approved for them. And so putting money down essentially offers that opportunity, one, to qualify for a credit card, and then two, it becomes to responsible use, using it below the 30% credit limit, to start building it, having that relevant, good payment history, and then ultimately qualifying for an unsecured credit card. A lot of lenders, even if you do a 300 secured credit card or whatever limit you put down, they will trust you with responsible use. You typically will stay within 12 months, between 12 and 18 months. They'll give you a collateral back and give you even a bigger limit. So it is a good foundation for someone who's looking to start building credit with no credit experience at all.
So I would disagree a little bit on that, just from personal experience on it, because a lot of lenders do have college cards or beginner credit cards now. Like my 20-year-old son just got his very first credit card, had nothing at all. So I would always advise you apply for a regular or one of those credit cards first before secured. If you can't get approved, then we have a couple options, right? One of those options being if you have a parent or guardian or somebody that does have good credit that can get a credit card in your name. A lot of lenders, I don't know about all of them, but I can speak for a couple in particular that I know. Them adding you onto their credit card as an authorized user will report to your credit bureau and help you start building. It's not in the same capacity as it being your own, right? 'Cause you're not financially responsible for it, but you're on the card and it will start to build some credit. Let's just show as an example, like maybe 6 months. After 6 months, go and try and apply for a card again on your own and see if you can get approved because you have something established. I've seen success with that. Now, not everybody has that firm family situation that they have somebody that's willing to or has the credit to be able to help them out. Therefore, that's when I would recommend a secured credit card because you need to do something. But a secured credit card is not always your ideal credit card because you have annual fees usually. They usually don't have good points or reward programs for it. And you are putting money down. I mean, there are some places that if you want $1,000 limit, you got to give them $1,000. But there's some that you want $1,000 limit, you may only have to give them $300. So there are different types of secured loans.
For someone who has no credit, for someone who's not in college, and typically with college credit card have an age limit. So you will look at maybe 25 and below. And so it is a good foundation for, especially for someone who's in college or for someone who has that backbone where they have a family member that they trust that they can be added as an authorized user. I mean, it's a good option, but it's not everyone who has that ability. It takes trust. So for instance, if somebody walks in today and say, add me as an authorized user to my credit card, I have to trust you to use it, to be able to use it. It is a good information, but you also want to look at, as an adult, somebody who's working, who doesn't have a relevant credit history, or someone who has damaged credit down the line.
So there's the next one I was getting to is, if you've had bad credit before, then
you
that's
can
a great
use the
point
secured card to start rebuilding credit history. But all along, it's not necessarily, it doesn't have to be a secured credit card. We can always research, and I always say pre-qualify, because a lot of companies will offer clients an opportunity to pre-qualify before they even apply for a credit. So this would be a soft inquiry where it tells them based on their credit range what they would qualify for. But I've seen a lot of people really get stuck because on their first beginner stage, because they have the desire to build credit. They want to build credit. They want to apply for credit, but they're applying for the wrong credit cards and getting declined. And all along, you'll find somebody who is in their mid-20s, mid-30s, never used credit because they've tried, they haven't approved for it, and then they give up. And so obviously, a college credit card would be ideal for someone who's in college because there's an expectation they don't have a credit history. But for someone who's an adult, who doesn't have a backbone where they have somebody to be added as an authorized user, a secured credit card would be a good way to go.
So that was to my point.
And
is that
rebuilding
they
credit
have a
also.
niche market for specific people.
Correct.
I wouldn't just run out and say, hey, give me a secure credit card.
Yeah.
I would look and see about getting a traditional credit card first, and then if not, then that's the route to go.
Yeah.
So let's jump into that because we only got so much time left. But secure credit card to rebuild credit. So we've had credit, we've had some negative credit. how do we go about rebuilding? What advice do we have for those people out there with that
Yeah,
situation?
everything that that Ben talked about, you're right. I was thinking, yes, is folks that are a little more seasoned that have been out there. You have some rough patches, but I think most banks have different programs that are out there. Secured credit cards are a way to go. There's micro loans that are out there. We have what we call a Money Smart program, where you can go anywhere from $500 to I want to say it's up to 5,000. But it's almost like you put money in, you're paying on that money. There's no interest. At the end of the day, you're getting that money back. But the whole process is you're paying. You're establishing a payment history on that loan. So, yeah, I think he hit it. There's different stuff. Just research. There are things out there, that can help
Or
you.
to your point with the different loans, the CD secured loans where you could learn some interest, right? You put money into a CD, use that CD as collateral on there, and then it could be earning money, depending on what the rate is that you get for it. But there's different type of lending opportunities out there. So with the time we have left, why is it important to build and have a healthy credit life, right?
I think it depends. One, it helps somebody be able to borrow money, and it gives them an opportunity to save money by qualifying for the lowest interest possible. It's also a gap, a generational. It closes that generational gap, because now it affords someone with better housing. It affords someone with the ability to buy a home, to be able to rent in a better market, be able to afford things cheaper. And particularly when we look at our daily life, I always consider first thing someone who has no credit, and I'm being more realistic in the real world where they need, for example, I need a car and I go to a car dealership. The first thing they do is pull my credit and tell me you don't qualify. And they offer you two ranges, either buy here, you hear people say buy here or pay here, or you get qualified for a car loan that has a significant, high rate. So the ability to borrow money cheaper offers you an opportunity to have the lowest monthly payment possible and manage your debt to income ratio as much as you can.
Great point there, because if bad credit or no credit can cost you more money in the long run.
Yeah.
Right. You have a good credit history, it's going to be cheaper for you to obtain and borrow money.
Mm-hmm.
On that same note, when we're talking about building generational wealth, I think there's a misconception out there that wealthy people have all this money and they buy everything in cash. They don't need lending. That's the complete opposite way of the way they think. Right? If I can use the bank's money, why would I use my money? My money is going to be invested and growing. Why don't I go use the bank's money at 3%, 5%, or whatever it is, because I'm making 10%, 20%, whatever it is on my investments that I'm making.
Yeah.
They'll borrow money to invest, right? That's building generational wealth.
Yes.
Yeah.
And you'll see two people. You could find two people, one qualified for a $20,000 car. One got a 4% rate with a $300 payment. The other got a 20% rate with a $900 payment. And so even if the two people make equal monthly payments, one is really at a harder place because one, they would have to have a very high income to lower the debt to income ratio, and that impact the ability to buy a house or to even qualify for things because of those two rate differences.
Mm-hmm.
Yeah.
And I look at it, I mean, it's just when you talk about protecting your credit is having options, to sit back. To your point, do I want to pull some money out of my savings to pay this, or do I want to use somebody else's money that is at a fair rate that, I'm not getting taxed on? So that's how I always utilize it. Because to your point, I mean, if I own a home, I can utilize my home becomes my own bank. I'm pulling, my equity out of there, utilizing the funds in my home versus I don't own a home because I couldn't get it because my credit was poor.
That's the mentality of wealthy people. Is most people's dream is to have their home and have it paid off because it's security. I own my home. I don't have to make a payment on it other than your property taxes, which is a different story for another day. But
insurance.
They look at it as dead money. If I have a $500,000 home and it's paid off, well, there's $500,000 in equity that is just dead. It's not growing. It's not doing anything for me. Let me go get a home equity line of credit. Let me get a loan on this so I can get that cash and go put it in something. I might pay 5% on it, but I'm going to once again make 10% over here. They look at it as dead money. So it's a complete difference in mindset, right?
Correct. And the thing that I'll add that goes hand in hand, all the stuff that we talked about, there's a reason we talked about being in college and credit cards. Because when you're young, A lot of young people that don't have this education and the families aren't talking about this, this is where the mistakes start. And so by the time you get off to where you're ready to buy a home, you're ready to buy a car, mistakes that you made as a youngster and that you made when you're in college are affecting you now. You know, whether it's whether it's student loans or you bought a car that got repossessed, these things are coming back to haunt you. So it's all about the sooner you can protect yourself, the better off you are. And it's funny, you talked about that authorized user. There are a lot of families that understand that, and they've got their kids on their car. So every time they're purchasing something, their kids credit. So by the time they come to see me at 24, 25 years old, they want to buy a house. They got 800 credit scores. They ain't never bought nothing in their life, but it's been established by the
Crazy.
parents.
I don't understand how that works or why it works that way, but it does work that way. And I raised my hand because I think I've told the story a few times on this show, is that's exactly how I started building credit. I never had any late payments or anything like that, but first day at IPFW, now PFW, credit card person there selling credit cards. I signed up for one, got my first credit card, $1,000 limit, something like that. Immediately went out and bought a stereo system for my car, right? I made the payments on it, but essentially it took me probably a year and a half to pay off that $1,000 because I'm making minimum payments on it. I'm going to school and working and living on my own and everything else. Did I need that stereo system? Probably not. I really enjoyed it, but I didn't necessarily need it. So using that credit card responsibly, not getting it, not going out and buying something you don't necessarily need, but utilizing it for your everyday purchases like gas, groceries, things like that, that instead of using your money in your bank account, your money in the bank account sitting there, you're using the credit card, and then you take this money to pay that money off. So at the end of the month, you don't pay interest, and you used it just as if it's yours, but you're building credit, earning points, doing all that stuff. That's smart, responsible, building your credit, right, for young people on there. So other than that, before we get out of here, anything else anybody wants to add to this topic? I think we could go on for quite a while on it. There's a lot to touch on, but I think today's conversation is pretty good. Anything?
Last thing I will throw out there, of course, for those people out there that do have better credit scores, that are actively building credit, if you're not actively utilizing your credit, call your credit bureaus and lock your credit. People will try to steal your identity. It happens.
Yeah, everybody should do that. Yeah, lock it.
And I just say this, that credit card is not a magic wand. As I say, you not, hey, let me get this, let me get that. That credit card or debit card for that matter, you know, don't buy something with that credit card that you can't pay for at the end of the month, you know, if you can help it. We know emergencies happen, but again, if it's just for, you know, pleasure, something that you think you want, i.e. your stereo, you know, no, hold off, just use it for essentials and pay it off at each month and put yourself in a better situation, you know, credit-wise.
Yeah, awesome. So, JJ, anything going on in the community that you want us to know about before we get out?
Man, you know what? It's a bunch of stuff, but I do not have anything on my calendar. You know, we've been off for a while, and I did not come in here prepared to let us know.
Can I add one more
Yep.
thing? I wanted to add one free resource. So annualcreditreport.com is really a free option for anyone who wants to pull their credit and get their full credit report from the 3 credit bureaus. So that's a good start point for anyone who's really trying to understand their credit. Annualcreditreport.com. Log in, create a file, profile, pull your credit, at least see what's reporting on there. It gives you even an opportunity to dispute things that you do not approve, that you did not approve, or things that you've already paid off, but also gives you a time for reflection and makes you understand exactly what's affecting your credit and how to do it. If you have late payments, it's never late. You can always look at consolidation options. If you cannot get those, call the lender, see if you can get on a payment plan. If anything is on collection, always call and see if you can get at the minimum credit payment plan. And that helps you revamp rebuilding that process. But annualcreditreport.com, it's very useful.
Two things with that. You're exactly right. But understand, it is free. A bunch of different websites come up. They're going to try to beat you for money. But the correct one is free, doesn't cost you anything. And then the other thing, everything that Ben talked about is 100% correct. You're not going to get a score, but it's going to tell you what's on there, what you're working with. And it's a useful tool.
That's where I was going with it. So you can pull, you have the law, you can pull your credit bureau from there once a year, each one of the 3, once a year for free. Doesn't give your credit score. You can get your credit score, but they will charge you for that. But it gives you the ability to at least get a copy of it, stay in touch with it, find out if there's anything that shouldn't be so you can dispute it. To your point there. One other resource, we talked about TransUnion, Equifax, and Experian. You talked about locking your credit bureau. That's how you would lock it. Go to each one of the credit bureaus. They have, I think they all three have apps that you can do, and then you can lock them directly through there rather than going through some third party that does it for you that you may pay a fee or something like that for. But Experian, TransUnion, and Equifax are the three credit bureaus, and you can contact them to put that lock on there. That keeps your credit frozen. So if somebody goes to apply for something under your name and they've stolen your identity, it stops them from being able to pull your credit at that point in time. Then if you need to pull it for any reason, you just temporarily unlock it. So before we get out of here, one last thing. We do have a special occasion this week, anniversary. Anybody know what that is?
What is
What
it?
is that?
No? This is the 3-year anniversary of the financial pillar.
All righty.
Yeah. Yeah. I didn't know if you guys would know that or not.
No,
We're
we
on the
didn't.
original show, but it popped up on my Facebook timeline from when we posted the first one with me, Mark. Why am I drawing a blank now? Our friends over at the.
Oh, gotcha. Yeah.
He's gonna be mad at me. I forgot his name. I'm sorry. But yeah, so we started the show. I just saw it pop up, so I want to give it a shout out. 3 years to the Financial Pillar Show. Okay. So, gentlemen, great conversation. Till next time, we'll be back in 2 weeks. We are Our Neutral Voices. Peace.